Good afternoon and welcome to the ZIGUP PLC Investor Update. Throughout this recorded update, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time by the Q&A tab situated in the right corner of your screens. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Ross Hawley. Good afternoon to you, sir.
Thank you very much, Alessandra, and welcome everybody. So as I said, this is ZIGUP's FY25 results, which we announced middle of last week, and we are currently on roadshow. And so I'm here with Martin Ward, Chief Executive, and Richard Clay, who's our interim CFO at the moment. So welcome to you both. We've done this a number of times before as a fireside chat, and it seems to be a format which works quite well. And what that does mean is that we're very encouraging of questions which will come up. My laptop is here, so I can see all the questions coming through, and I'll try and weave those in so we don't have just kind of the conversation and then trying to follow up the questions. So please do ask questions, and we'll try and get as many of those done as possible. So I think with that, I think really it's wanted to kind of kick off by saying, Martin, maybe you want to give some context to the overview, to the results, maybe using the first couple of slides of the presentation, and then we'll just kind of take it from there.
Okay, Ross, and good afternoon, everyone. So look, just first thing, stepping back, we beat market expectations with this set of results. We had a very strong sort of second half, which sort of improved our position from what we reported in H1. So that's the first sort of takeaway. I started the presentation for the analysts and our investors with a operational slide this year, which is very unusual.
Yep.
I wanted to do that simply because I think it captures sort of what really has been the heavy lifting in the business this year, with a number of things on the go. So to give a little bit of context to that, we had the new brand with ZIGUP, so that was introduced into the business, and the strategic narrative that sort of fitted around that. Big one for me was the organisational restructure and the formation of a single management team in the UK and I. When we brought the businesses together previously in the merger in 2020, we did some organisational restructuring then to see how we wanted to face off to the markets. And then as our business has learned up each of our customer profiles and understanding of the products and services we offer in the integrated mobility platform, then it made sense for us to have a sort of a one touch, a one road, a one sort of way to market, where all of our team were well versed in what we were offering out to our customers. And that's worked really, really well since we've done that sort of organizational change. Also from a sort of a customer side, simplifying that journey was important to us. So, we talk about the platform of services, but how easy is it to access those platform of services, and what response do we give as an organization when that cuts across our sort of businesses across the group? So we've simplified that to make sure that we've got some easy touch points using technology as well to enable that. And clearly we had a lot of customer wins and contract renewals this year as well. So it's been a year where we've solidified, extended our position in the market, not only with our existing customers, but also with new customers. So that's been great. And then what does that all look like? Well, we grew our fleet. So we've been investing quite heavily in that sort of profitable growth. We grew our fleet just over sort of 2%, demonstrably more in Spain than in the UK, and we'll come on to the details on that. It was good to be recognised as well for the King's Award for Enterprise for the investment in people. I mean, we're a mobility business. We provide a lot of on-the-ground services. And the thing that we were recognised here for is mainly our apprenticeship scheme and social mobility. So we have over 400 apprenticeships in the group, and a good retention rate when we put those apprenticeships through their training course. And that's been really successful for us as a business in terms of where we get our future stars to do our services. And then also in our facilities, we've been expanding our facilities and renewing facilities, and by facilities I mean property, I mean our sort of infrastructure on the ground. Providing services into facilities that are what I call fit and proper for a FTSE 250 business, getting the right size types of premises that we want to operate from, getting the right sort of workflow and productivity out of those premises, and having a really good working environment for our colleagues And that has proved that we can increase productivity, capacity, and efficiency.
So I think that there's kind of words at the top which we put a year of operational heavy lifting. That really was actually, I think, when we kind of talked about that together, that was really quite a good characterization of the year.
It is. It's a phrase I use a lot when you have to do a lot in the business. Don't get me wrong. The outputs and results, the financial measures, and all the KPIs have been fantastic. But it's not by accident. As I say, we have to put a lot of work in to get there, to make sure that we're sort of future-proof for what we see further down the line and how we set ourselves up for success. We're expecting growth, and we'll come on to talk about that as well in terms of where that's emanating from. But you have to do the hard yards to make sure that you are fit and proper for the next phase of your delivery. So yes, heavy lifting is what I call it. And ultimately, investors on this call, our shareholders, say, okay, what does that all mean? What does it all mean? Well, I suppose the financial outputs and the KPIs are the outputs from that. So, if I can just give a brief summary on that, I think that'd be helpful. Richard will go into detail, but I'll take it. Investors have seen our slides. They can sort of see the numbers. But firstly, just some context to these numbers. As I said, we beat market expectations. Yet when you look at the results on page 1, it looks like we've gone backwards. Mm-hmm. So the context of that is clearly, I've talked about this, post-pandemic, we've had some tailwinds which have benefited the business. Things like residual values on our fleet. So as we've been sort of defleeting, the price that we've been able to achieve when we're selling our vehicles into the market has been elevated. We've signaled that, we've talked about that a lot. It's not a main feature of our business, but if you hold those assets and they're worth more, of course, we're going to benefit from that. And the second thing was in our claims and services division. We saw that when supply chains were constrained for repairing vehicles and getting parts through, it took longer to repair vehicles, and consequently we had some longer lengths, which benefit the P&L. So those have now come off in this year, but they were a feature of the past. So when you look at those tailwinds going away, effectively you get what I call the underlying performance of a normalized business. I think that's what we've seen mainly in this year's results. So as I said, contextualizing that against why we've got so many things in brackets that go backwards in some ways.
So in many ways, kind of tailwinds, headwinds, which we've been impacted by, we're almost feeling that actually when we look forward, which I think we'll come on to shortly, is something whereby actually things are much more stable and actually there's a clearer line of sight there as well.
Indeed. Look, the biggie is the investment in the fleet. So, we've been putting a lot of CapEx into the fleet this year to replenish the fleet, to support the growth. The new vehicles that we've been buying have been a lot more expensive than the vehicles that we used to buy. So we have to take that into account in terms of how we price that out and how we maintain our margins or grow our margins, as the case may be. So a lot of investment doing that this year. And Richard will come on to a slide that talks about what the shape of that looks like. So quite a lot ongoing, but when that all sort of moderates and you get your fleet to where you want it to be, bearing in mind we've got quite a young fleet now, and there's not much further to go, then obviously everything just normalizes and you get a sort of steady picture of where the business is going and how that sort of underlying growth is coming through.
Yeah, and maybe just before we move on to the next slide, 1.5 billion of fleet assets. That's a substantial fleet. That's a lot of tangible asset values there.
It is. We've grown our net book value of our fleet by over 200 million this year. We haven't increased the debt by that much, so obviously the assets are growing. And just a reminder to everybody, we bring assets on board that we rent out on the rates that we've talked about, and we get the benefit of that over the life cycle of that asset. So if we buy a car or a van and we keep it on the books for 3 or 4 years, we're getting the future cash flows, the future profitability from renting that asset over time. So when you've done a lot of investing in growing the fleet, as I said, it releases the benefits, and that sort of is why our confidence is underpinned in terms of where we see the growth going forward.
And maybe just the final slide, if we can, on this part. I think one of the things which people have noted was a real sense of confidence, I think, in terms of the statement, in terms of the outlook, and how we've talked it around the market. Actually, that's been a notable view with that kind of line of sight. Do you want to just kind of summarize that, your kind of feelings on that?
Yes, look, I mean, we've given a lot more detail in our presentation this year. We take feedback from the market, we take feedback from investors, what they like to see. We don't want to overload people. It should be a fairly simple story in terms of what we do. And I think the last 5 years we've gone to great pains to make sure that our sort of investment case is understood. But when we look through that model and we look forward, we can see where those touch points are, where the delivery is, where that extra growth comes from, what our profile looks like, and what we can basically bake into our position. And I think when having done this now for some time, we are very confident in terms of what we've been able to put out there in terms of guidance. I think it is the first time where we've given some real guidance on sort of where we expect EBIT growth and all the rest of it. But that confidence is underpinned by what we can see in the investments that we've made in the business and all the actions that we've taken over the last few years, and that is supported now in terms of what we're seeing.
Yeah, and I think at the analyst presentation we had Jorge and Harvey there as well, and when I know it was an intention of yours to allow people to have a little bit more insight into kind of how the businesses were working, but equally how kind of the market environment was in both of those. Maybe if we just kind of drill down a little bit, can we start with Spain? Because I mean it's a lovely one to talk about.
Indeed, yes. I mean, look, as you say, we had Jorge. I brought him across to present on the Spanish numbers. It was a fantastic set of numbers. Spain has achieved a lot in the last 5 years. The Spanish team have outgrown the market in terms of, if you think about the market has grown 5% for flexible rental in Spain, we grew 11%. Yeah. So more than double what the market grows there. And then if I look at sort of how we're executing on the ground there, we have grown our margin. So although we've grown our fleet, we've grown our customer base, we've grown our profits, we've done that on a differentiated business model. It's not a price-driven strategic position to buy market share. We've done it whilst improving our margins. And if you think of the Spanish market as a whole, there's only 3% penetration in the rental in the market. Compare that to the UK, there's 12% penetration. So it's still quite an immature market. There's a lot to go for. And we're very well positioned with the services and the products that we have in Spain, and customers are polarizing to what we offer. So again, that gives us the confidence to talk, about where we see Spain going and what that can deliver for the group.
Absolutely. And then maybe just thinking about the UK, I know we don't like to sort of dividing it up into businesses, because actually we've done an awful lot of work this year to bring the two capabilities together. But having talked about the Spanish rental market, just your thoughts on how the UK, we've said, the most, the highest in terms of new business wins this year, very strong retention, etc. Clearly doing all the right things here as well.
Indeed, yes. And as I said, that sort of organizational structure change was mainly about the UK in terms of how we bring our products and services and our management team together to look at that sort of singular proposition across the integrated mobility platform and how we can have those conversations with our customers. And that is bearing fruit. That's the strategy that we laid down. And that is bearing fruit because we're getting multiple cells into a customer who's taking different parts of our services across the platform. And they can do that through a single point of contact with our accounts and development team. So it has been a really good year, because obviously when you're doing that with a customer and you're drilling down and sort of looking at all those products and services you're providing, what it's showing to us through our sort of feedback and our data is that we've got some very sticky propositions here that customers like. That, for me, that plays to quality of your earnings. It's not a case of it's a business that you just rent an asset, it's a piece of metal, it's a race to the bottom, and it's a short-term transaction. We've got customers who have been with us a long time. Yeah. A large majority of customers have been with us a long time. And the fact that they're taking more products and services from us just solidifies for me the strength of the relationship, the strength of the service offering, and as I said, that overall quality of earnings. And there's more aspects to the UK now than just rental, of course, all the claims and services. Yeah. And that's the business that has been, growing its position in terms of taking on new customers. Yes, it's got to manifest itself through on a normalized basis, seeing that sort of EBIT growth and everything else, and we expect to see that, as Richard will come on to talk about. But, we're a major provider of services for insurance companies and brokers, automotive dealerships, lease cos. So, when you look at the trajectory of what those companies want, they want to outsource their back office functions and claims and services and replacement vehicles and repairs. And we're a national operator with good infrastructure on the ground, good technical skills, good people, and more importantly, fantastic NPS and Trustpilot feedback. So we're getting it right more times than we're not. So all of that bodes well for me in terms of the investments that we've made and what we're seeing. So as I said, so what it all translates into something which we will call growth.
Yeah, and just before I hand over to Richard, and I'll talk just a bit about the Q&A, the UK market environment, we always timed our results at the time when the government came out with sort of more infrastructure spend, etc. And we got a lot of our end markets really with critical infrastructure, critical end markets, etc. We are very thoughtful about where we place our vehicles as well, aren't we?
We are. I mean, it's important that we get the right returns for our assets. So I said, we came out with results on Wednesday, the 9th of July. The government announced on Tuesday, the 8th of July, a reconfirmation of a 92 billion infrastructure spend. So It was agreed last year. It went on pause for the spending review. It's been through the spending review and it's reaffirmed. So we'll see sort of major infrastructure upgrades, things like the A66 Scots Corner to the Lake District, M54, M6 links. So you're right, we've got customers in those segments that we support and are well supported. And we've seen that sort of confidence on the basis that they're going to need to be well equipped to do those projects, and where we can support them with our sort of mobility platform. So look, there's a lot of good things there that give us confidence then about choosing the sectors, choosing the customers and the markets that we will invest in. And equally, as you say, being selective about the ones that we don't invest in, because it's about getting the right returns for our assets and growing sensibly, not just growing for the sake of growing. That's important, and I think that's a differentiator probably to where the business was in the distant past.
Yeah.
It is about quality of growth.
So I'm going to take a pause there and bring Richard in. I think we should talk about fleet a little bit later, which is something else I want to do. But just, Richard, maybe give a bit more of a context, or rather talk us through some of the financial metrics, maybe the profit bridge as well, just to kind of give a little bit more views on that. And I'm worried that I'm slightly out of view here, so I'm going to not having looked at that. Also, sorry, yes, please just carry on with that while I'm looking to see if I can encourage people to ask some questions.
Great. So I'm going to start on slide 8 of the presentation. So the first key point is that our results were ahead of expectations, and Martin talked to that earlier, but just to bring that out in the numbers on this slide. So first of all, revenue was 2.3% ahead of prior year at 1.555 billion. Profit before tax was at 166.9 million. That was 3% ahead of consensus, and that was the main driver of our statement around ahead of expectations. And then within that, you can see also the growth in the cash profits of EBITDA, up 18.2 million, and also the confidence of the board in these results and the growth in the dividend per share going up 2.3% as well to 26.4p for the year. What I also then talked to just before I move on to the next slide would be net debt and leverage. So our net debt was up 95 million. Leverage closed at 1.8 times, as we'd signaled many times to the market. And importantly, that 95 million of increase in net debt, what does that fund? Well, the fixed assets, the net book value of the fleet went up by 211 million. So that's an important stat to link those two numbers together to see how well funded the group is.
Yeah.
Talking then to the profit bridge, which was slide 10, so 2 on, you can see a bit more about where did the growth come from, but why did the underlying numbers go backwards year on year? And the first key point I'd point out on this slide is rental profits were up 10 million year on year. That's a really strong performance, and that's not only margin growth, but also volume growth. So you can see the split on that slide. Then disposal profits came down year on year, but as said, we've signaled that they're normalising. The residual values that went up during COVID are coming off. They're now largely normalised. H2 was stable, and so that's a key component to the walk. And then 2 elements in claims and services. So one, the cyber incident that we talked about in H1, and then some other claims and services dynamics, which there's a slide on later, but basically come down to another normalising factor that Martin referenced, which was higher durations. So our vehicles, replacement vehicles out with customers being repaired quicker year on year, and that led to a reduction in profits year on year. But the good news there is that they've stabilised.
Absolutely.
And so across H2, we saw no further degradation. We feel this is the position that for the future, and actually from here we can see growth. So into next year, hopefully we won't have another cyber incident, and we'll see growth across the other parts of the claims and services business. So that would be my key points on that.
Okay, good. And I'm almost keeping with you. Thank you very much. I can see a good number of questions. So if I'm kind of leaning off screen, it wasn't meant to be off screen, it's because I'm pairing up my Q&A, and I will bring some in a moment. But Richard, if we move on to the margin slide, in terms of the medium-term view, there's been a couple of questions, sort of are margins peaking or otherwise, maybe for both of you to handle. But actually, in terms of our medium-term view, that was again, Martin, you said something new for us to kind of give more to the market. In the first instance, I'm going to risk saying, Richard, do you just want to give a couple of comments on that slide, and then maybe Martin a bit of an overview?
Yeah, so
maybe that's the one way around.
First of all, absolutely not peaking. And what we did here on the medium-term view slide is really give a lot more detail than we've done before. So we used to say rental margins of 15% plus. Here we're saying 15 to 16 in the UK and I, and 17.5 to 19.5 in Spain. So a lot more clarity on the next few years of rental margins. And yes, they're higher than they were previously. In claims and services, the margin of 5% plus, it compares to this year's margin of 4.3%. When you add back the cyber incident, you get into the high fours, showing our confidence. We're showing that we expect 5% plus. The reason that that's moved around over the last 5 years is the change of mix of business between higher margin styles of business like credit hire and credit repair, and lower margin styles of business like direct hire and direct repair. And then we gave more detail also on disposal profits, but I think your question was mainly about margins.
Yeah, it was. And I think, thank you very much on that. And obviously we'll come through because there's some more questions on this. But claims and services, I want to talk about fleet, but claims and services, a couple of questions coming in. You sort of indicated earlier quite positive about that business, but also there is this element of business mix change, isn't there? And the margin is actually not reflecting that the business it's more reflecting that there's a change in the kind of business we're doing with those major insurance companies, isn't it?
Yeah, I think that's an important thing. Again, look, I appreciate investors see 200 companies a year and all the rest of it, but what we've got to contextualize is that where claims and services came from, it was more pure play with credit hire, credit repair, which is a sort of a higher margin type of product. And then when we merged, we said we were going to use, this was part of the reasons for the merger, we're going to use that operational leverage. Northgate and Reddy, merge their branches that give you a bigger footprint infrastructure-wise. The consequence of that is that you had a lot closer reach to customers, and through your branch network and so on. So what that gave us is operational leverage, as I say, to enter into what I call direct hires. So where we're providing services across that platform, mobility for insurers, we can get to customers quicker. Therefore, we can price in different products and different services, which enable us to grow our sort of position. So, look, in absolute terms, we want to be a main provider of mobility services in the markets that we serve, and being selective around sort of doing the direct hires, the credit hires, and all the rest of it, all forms of replacement vehicle. Yes, the margin will change because you've got that different mix, you've got the different characteristics, and we're comfortable with that. That's something that if we win a big contract and we say, okay, this contract is a direct hire type contract, yes, it could look like it's dilutive on the margin, but actually, Richard goes on to tell you, the ROCE's the ROCE and the capital investment from that is actually very strong. It's sometimes in excess of 20%, so it's a good place to be. And we want to use that leverage. We want to use that operational leverage to do that. So, yeah, we shouldn't get too hung up on the actual EBIT margin itself. It's what does the overall look like when you stand back.
So the competitive environment, there's lots of questions. I've got a feeling I know who Richard L is in this because we talked about him now and again. the competitive environment within the claims and services space is actually very much kind of moving in our favour in terms of the structural trends, but also technology, so that there is profitable growth there. With those contracts.
Indeed. Look, I mean, if for those of you that are not familiar, I mean, the claims and services is working in the arena with the large insurance companies that I mentioned earlier, leasing companies and so forth. And, we've seen, some consolidation in that sort of personal motor space very recently with 2 listed businesses. And as I said, if you have I hadn't said it yet, but if you've got £1 of investment in your insurance company, do you want to spend that on your marketing and your brand, or do you want to spend that building your administrative capability? Well, the answer is actually, you want to spend it on your brand, and you want to work with a partner that is very efficient, that can, use the tools necessary to be able to process transactions and customers through an event. And that's what we specialize in. So, this trend to outsourcing, we're just low 20% of the market in terms of our market share.
Yep.
When we measure all of the market, and therefore there's a lot further to go in terms of what we can do. And we're a national provider of scale with good credibility. We've talked about the NPS scores, Trustpilot scores, excellent credibility, I should say, not good. And we're a trusted partner that can deliver those services. So there's more to go for. So that's where we see growth.
Okay, and I'm going to jump to something I thought I'd talk about later, but technology investment actually is something, particularly in claims and services, let's focus on that first of all, where really it's our scale and our ability to link into the insurance companies, which is providing efficiencies for both parties, really, isn't it?
Indeed, look, there's a high number of transactions that we undertake in the business at any one time. The boards, we signed off recently on a 10 million plus AI investment in our contact center technology. I guess we don't shout a lot about the tech because we just go ahead and do the things that we need to. Yeah. We OPEX a lot of the costs that's involved. Only go to the balance sheet if it's servers, etc. But we've spent and invested quite considerably in building these tech stacks and AI for the business. And what does that give us? Well, it will give us efficiency, because when we analyze the calls coming into our contact centers, we can see very clearly where they fall. And sometimes these are queries with just updates on where my repair is. When do I have to give my replacement vehicle back? And they're queries that could be answered very efficiently without human intervention. Where you do need human intervention is when someone's had an incident and they're stuck at the side of the road with a broken down car. They've been involved in an incident of some sort, and they need that reassurance. And that's what our insurance partners look to us for, to be able to provide, a human voice, a pickup call that can put everybody where they need to be, put them at rest, that things will be taken care of, and move on with that. But the mundane stuff can be dealt with by, virtual assistants and using that tech. So again, look out for that as we report our results next year. Keep moving forward. We'll give a bit more visibility on what productivity and efficiency gains we're getting from that investment.
Yeah, excellent.
As an example, that is, by the way.
Okay, and I was going to say, Peter, hopefully you were asking questions about innovation and how important that is. I think it's the technology side, which actually is where we're seeing some of that really coming through to profitability in the bottom line.
Indeed.
Can we just touch on fleet? And then I want to ask Richard to go through sort of some of the CapEx views. But residual values, stabilised, fleet availability, good? Yes?
Yeah, that's the case. So I don't think we need to spend too much longer on that. So markets are open. You can purchase whatever vehicles you need these days. So there's no shortage of supply, both in the UK and Isle of Spain. Residual value has been stable since about October last year. So, we called it. We said that we expect to see them sort of continue to decline, which is great. We're not looking to make a big profit on disposal. Effectively, if you got your depreciation right, you land in the right place. But yeah, residual values have stabilized, as I said, since October last year. And our view is that whilst they'll still come off a little bit, they're still, stable. They're stable.
Yeah, very, very definitely. Right, said a lot. Richard, just before we go in, so we've done some refinancing. There's a question here on Jack. So just, refinancing this year has put us into a very strong position, slightly different kinds of financing, some asset financing, I think was a question here as well. But broadly, we've got a group of banks who are very happy to lend to us in a range of different ways. Do you want to just...
Yeah, so we went through a lot of refinancing during the last 12 months, to renew our revolving credit facility, but also looking at any other forms of financing that would make sense. And we added an asset financing facility based on rate and efficiency to the cost of debt of having that, and successful program across the board. So both through the private placements, the RCF and the asset financing facilities and the smaller facilities, we now have a broad cross-section of financing arrangements, which de-risks any approach that could come at us. So we end the year with 412 million of headroom. That's a very strong place to be in. There's nothing really coming up now for a while. You've got a lot of long-dated financing arrangements, so that gives us a lot of certainty about the future.
Okay, and banks are very keen to lend to us.
Banks are very keen to lend to us. They look at our 1.51 billion of assets and say, well, that's very easy to lend against. And they give us 3 covenants, but they are very normal in the market. We have a private rating. It is a very strong rating. Yeah. So overall in a very good place, and really does show the banks are fully supportive of the organisation.
Fantastic. So I'm just going to take a slight pause and just go. So in the presentation, people have seen a number of slides from us, familiar with those, and then you included a couple more this year. Where we were trying to dig in, partly some of the investor, partly analyst, wanted to understand a bit more, particularly on sort of the capex and the cash flow profile. I wouldn't want this to be a session where we're going to go into the weeds of that, because I don't think that's a thing. The transcript of the presentation, which you went through in quite a lot of detail, is available on the website, so I'd encourage anybody to go and look there. But if we just kind of upper level and just kind of maybe you've got some takeaways from those slides and actually what we're saying, because we talked, Martin, about the business model. It's not changed. We've used debt to buy fleet. Mm-hmm. We're a capex business, but we care about ROCEs. Rich, take over from me and give some.
Yeah, so I put in a couple of extra slides, one to explain the capex cycle, and the other to show our approach to capital allocation, just to remind everyone of our relentless approach to this, and to explain a little bit more why steady state cash was lower this year and what people should therefore expect into the future. And I suppose the key points that come out of that slide: 1, EBITDA is growing. The cash profits generated by this business consistently go up year in, year out, whether there's a pandemic or any disaster you could throw at it. EBITDA goes up. Why is that? Because we continue to have great opportunities out there in the market to be able to grow our fleet. Yeah. And that therefore comes through as cash profits, because people pay for these vehicles year in, year out. We've seen over the last 5 years many tests to that theory that have given us great confidence about the business model. So EBITDA goes up. Steady state cash flow falls when net replacement capex goes up, but net replacement capex going up is again a good thing, because that means you're buying more fleet and you're de-aging your fleet and giving a better customer service to your customers, which will provide future growth of revenue, profit and returns in the future. So a lot of that slide was designed to give those messages to the market. And then the second slide on ROCE and capital allocation. I suppose there are 2 points on this slide. One is that as you grow, you buy a vehicle at the beginning and you sell it at the end. And over that lifetime, the capital employed reduces because you're gradually depreciating that asset. Okay. But actually what happens with your higher rate and your costs is they tend to go up, and your margin tends to improve during the life as well. And therefore you get this returns profile which actually increases over time. So the more you put in of cohorts of younger fleet, it pulls down temporarily the return of the business, and that's not a bad thing. That's just something people have to understand.
So investment in the fleet made lower in early years that ROCE, but actually when we look at it over that time, I think you put some figures on the slide in terms of teens, double digits sort of ROCEs in the rental business.
Yeah, absolutely. So what does it mean in terms of returns? So we take a relentless approach to ROCE and returns, and it's very disciplined. Martin and I have a weekly meeting where we look at the returns on every single piece of business that's coming into the group. What can we see through that? We can see that the rental businesses return double-digit percentages, and we would never consider something lower than that. And then claims and services, we typically overall see 20% plus returns. So very strong returns on that side of the business, and arguably the first pound you would put into claims and services. But actually, all of these three businesses, these three segments, have growth opportunities. So we're putting growth into all areas, and funding organic growth therefore is fundamental to the future of this business, and that's where we focused a lot in this heavy lifting year.
Yeah, absolutely. Martin, I don't know if you wanted to add anything to that, and there've been a couple of questions just about shareholder returns in this, maybe talk about the dividend and how you think about that capital allocation.
I don't think there's much to add to it. I think Richard covered very, very well, actually. But that is the profile of the business. It is simple. We try and keep it very simple, Ross, in the sense of what we're doing. We want investors to understand how the business works. There's a lot of detail in there, of course, but the simplicity of it is you're buying assets which we're renting out, which you get future cash flows and profits from. And the key thing is when you're doing that and you've got all that investment up front, you've got to sort of take that into account in terms of how then is your future return supported. And when we talk about our dividend increasing and so forth, well, the board looks at that and says, okay, the profile of the business is X, very comfortable supporting that. And as I said, it's the type of business model that we operate. So I think you've said it all, Richard. I think the extra 2 slides, some people say, well, there's a lot of detail there, but actually it explains it in very simple terms, what the shape of the business is and therefore what to expect. And if people understand it, they can invest in it.
And obviously that was the analyst presentation where we clearly got some work to do with the analysts to help them understand some of that as well. But I almost want to bring this conscious on time. There have been a few other questions, and if people feel there's some which are quite detailed, I'm very happy to engage afterwards and provide some responses to those. But I think I just want to kind of, maybe Martin, I was going to ask you to kind of round up in terms of talking about people and technology. I think we've talked about the technology side of it. You touched on the King's Award, but actually investment in our people strategy, age of technicians, etc. Actually, that's all been part of the heavy lifting and trying to think about that sustainable future.
Yeah, look, it's a feel good factor about investing in your people and getting your future talent through the business and so forth. And but on the ground, operationally, it is important. I mean, a good example, I talked about it, is we've brought the average age of our body shop technician down 13 years. And that's quite not using any repair body shop filler. Actually, by having the apprenticeships come in and supplement and get fully trained within 2 years. So it just means you've got your future generation of technicians coming through to support your workflows. We've seen others struggle in the market about attracting talent. And when you've got the automotive industry and it hasn't attracted all that new talent, it is an achievement, and that's what the King's Award did. So look, warm, good feel factor, but it pays dividends further down the line, and we'll continue to invest in that and continue to invest in our colleagues.
Okay. And then maybe just if we put up the outlook slide, slightly out of order, but I think it's relevant just in terms of this is where the confidence in the business. Just to really summarise, and are there any final comments which you might have?
Look, I think for me, as I said, I think we've talked about sort of that confidence there in terms of our market opportunities, robust demand in terms of what we're seeing, a good fleet, as I said, that's been brought down in age, a good position with the integrated mobility platform. So, look, we've put that out there in terms of an outlook statement. Richard's talked about that sort of guidance for mid to high single digit sort of EBIT growth, disposal profits aside, which we can't control. So, I think that's the strongest position you can get. And for me, it's, reasons to invest in this business. Well, I look at it. I look at it from this perspective. I think, we're a good, solid business with a strong balance sheet. So it's a good defensive business in many, many ways.
Yeah.
If I just, people talk about, last year we got comments, why would you even contemplate growing the UK when there could be a possible recession or a downturn and so forth? And I said, well, we can be selective about how we grow. We can be selective where we put our fleet and where we put our investments, and we do that responsibly, and we do it within the policies that we set. And that's what we've done this year. And we can continue to do that. But we've got those growth opportunities. As I said, strong balance sheet, and also what does that growth look like, from all of the group? Talked about Spain outgrowing the market more than double the times. So I think there's strong reasons to invest from a sort of go forward position in terms of that growth, strong reasons to invest in terms of that sort of strength of the balance sheet and also the dividend that we pay.
Yeah.
And also, look, there's a lot of cheap stocks out there. I'm not going to go there with us and so forth, but quality of our earnings, the strength and sustainability of what we do day in, day out, that is manifested through, contracts that are on a multi-year basis with blue chip companies. So, as I say, there are strong reasons to invest in this business.
Fantastic. Well, look, thank you, both of you. I think that really wraps things up. As I say, there have been a few more questions coming through. Very happy to try and answer those. I'll do a little bit of an advert for our website because we've got a lot of information on there. We produce an investor update as well. So there's often an FAQ, questions and answers on there. So do please look there if you feel there are more answers you're looking for. But with that, I think, Alessandro, I'm going to hand it back over to you and say thank you very much for everybody participating this afternoon. And thank you, Martin. Thank you, Richard.
Thank you. Thank you all.
That's great. Well, thank you very much for updating investors today. Could I please ask investors not to close this session, as you now be automatically redirected to provide your feedback and all the management team can better understand your views and expectations. On behalf of the management team of ZIGUP PLC, we'd like to thank you for attending today's meeting, and good afternoon to you all.